Hello again, it's been a while since the last episode of London Direct, but I'm back to bring you more views from the most important financial centre in Europe, and I've been back to speak to an old favourite, Ishaq Siddiqi from ETX Capital. Clearly we have to talk about Mario Draghi's decision in Bratislava. They've decided to cut the rate by 25 basis points. This is just a sign of desperation, isn't it?
You could say that to some degree. I think it was one of the only options that the ECB had at this particular point in order to kickstart the Eurozone economy, which has been going through a pretty rough patch now. They started off the year on more of an optimistic note, hoping that we may get a recovery in the Eurozone by the later half of 2013. That hasn't been the case. Inflation has dipped. Unemployment levels are at record highs. The Eurozone periphery is still struggling. Spanish GDP has been contracting. That's the same case with Italy. Italy's finally come out of political paralysis, but the viability and the credibility of this government is still yet to be seen. At the same time, the crisis seems to be spreading to Slovenia, so Draghi had to pull the trigger. Expectations were high for the last week after the pull batch of data. At the same time, the ECB has been criticised now by Jens Weidmann and the Bundesbank, so they've been under increased scrutiny to start acting in some way. They haven't cut rates since July. They put out the bond buying program, the OMTs, which haven't at this point been used. The Italian and Spanish bond yields are at 30-month lows, so at this particular point you have to think the ECB needs to invigorate the economy in some ways. The periphery, at least Italy and Spain, seem to be going the right way to start implementing those right structural reforms, even though we're yet to see growth in those countries. But the fact is that the ECB had to do something and they pulled this trigger. The real question for the market now is, what more can the ECB do?
But for 1 second, if we can imagine that I'm a Greek teacher who's seen my salary slashed over the last 5 years, what does a 25 basis point cut mean? It means nothing, essentially, doesn't it?
Nothing. No. It's very insignificant. It's a complete symbolic move. If you're a Greek teacher that's seen your salary cut, you're in for a long road of struggle, and really, essentially, with central bankers, the Fed and the ECB at this point right now, it's very much wait and see and sitting on the fence. They don't really want to get involved. They really would like it if governments start implementing the right structural reforms and putting in their budgets and getting them in check and growing without the help of a central bank. But that means years of hardship for countries like Greece and Cyprus and Spain, and that's going to be this continual problem in the Eurozone for the next few months. Years. For the next few months, the immediate problem now will be how the crisis translates into the wider Eurozone core. If we're going to start seeing countries like Germany, which has recently suffered a bit of a blip in economic data, if we see a slowdown there, what does that mean for the Eurozone as a whole? Could we possibly see a breakup, a detachment from the strong Eurozone countries to the weaker Eurozone countries? So on the whole, it's not a pretty picture for the Eurozone for the next at least 10 years. I think the Eurozone has definitely lost a decade.
Yeah, I'm wondering who this cut is for, because as you said, it's not really going to benefit the real economy, real people, as it were. So is it just a case that this is to please the financial markets?
Yeah, I think the best way of looking at it is it's to ease conditions in the money market so banks can actually start lending to each other. Banks are still very cautious. A lot of trust has been lost, and generally at this point right now, banks they've been punished. They're trying to get their capital ratios up. They're still having to deleverage in a massive way, and there's a lot of caution within the banking sector to lend not only to each other but also to small and medium-sized enterprises, and that's what the ECB is trying to do. It's trying to get that money to trickle down into the real economy, because for the last 8 to 9 months since the OMT program, although these measures have been in place, we haven't really seen the real effect of an ECB measure really kick in. And like I said, now it's the question of what sort of measures will they employ. Would we have something which is a bit more unconventional, something that we haven't seen before, or would we have to look at the idea of negative deposits, deposit rate, which is actually kicking the euro a lot lower now. The euro is kind of flirting with 130 after trading higher. So there's a big worry in the market now as to what the ECB is going to do next.
Well, that's all for the moment. Coming up is an interview with Miles Eakers from Savvy Trading. We'll be talking about currencies, but for now, goodbye.